All right, welcome to this trade overview. Okay, welcome to this trade overview. We just want to look at what Euro USD has been doing and where Euro USD is going to. Okay, so my name is Big Lou. You're welcome to this trade review. I want to show us how Euro USD has been moving recently and where it is heading to, and the trade opportunities that we have gotten from Euro USD so far, and the trade opportunities we still look to get from Euro USD so far. Now, the strategy, the setup I want to analyze here, what I want to do right here is a very simple trading model that if you pay close attention, you can replicate this model. And this one trading model can actually sort you out for life. All right, it can take care of your bills, it can sort you out for life. Okay, so let's get into it without further ado. Now, there are three types of traders. This video is going to be a robust video. I want to take time to go a little bit deep so that if you come across this video, it answers almost all of your questions. It's not going to answer all of your questions, but it will answer almost all of it. It will go deep. This is a complete framework of beginning to end, start to finish, of how you can maximize the opportunities in the market using Euro USD as a case study. All right, there are three types of traders, and this is very crucial because with this, you know where you fall into and you know what to do. Okay, you know how to trade as the particular kind of trader that you are. There are three main types of traders. We have um we have position traders. We have position traders, right? We have swing traders. We have scalpers. Now, position traders trade on a very high time frame. Okay, they take their trades on a high time frame that enables them to hold a position for for months. You could see a trader holding a trade for 5 months, 6 months, 1 year, and all of that. That person is a position trader because they have so much money, they have enough liquidity. Okay, they have money to trade at that level. Sorry about that. They have money to trade at that level, so they trade on a very high time frame. You could see them taking analysis on the monthly and even taking entry on the monthly, taking trade entry on the monthly, getting the next drawn liquidity on the monthly. So before they get the targets, market has really gone far. Look at this trade here from October 2000. Traders that held this buy, we are in this buy till it took out liquidity here, which was around when 2007. Just take partials, they keep taking partials until the opposing liquidity is taken on a higher time frame. So that is position traders. Then we have swing traders. Swing traders, they also hold trade for long, but not as long as position traders. These traders could hold trades for weeks. They could hold trades a week, more than 1 week, and all of that. Even sometimes hold a trade of like 2 to 3 weeks, and sometimes even could hold for a month. All right. So you call those ones swing traders. Now, scalpers, scalpers are people that trade on the lower time frame. They get in, get out. Okay, they get in and get out. Now, when it comes to swing trading and scalping, they both fall under intraday intraday traders. Traders that get in and get out of the market within the week. You get in on a Monday, by Friday, you should be out of the market. They don't hold trades over the weekend. These are intraday traders. They can hold trades for a day or two and all of that. So why am I saying this? This will help you understand the time frame you should be analyzing your trade on. Because one of the prevailing issues traders have is that they analyze, you tell a trader to mark structure now. The trader goes to the monthly time frame and start marking structure on the monthly time frame. Mark structure as far back as the year 2001. This was bullish structure. Now we're in a bearish structure. All of this is none of your business as an intraday trader. Except you're a position trader, you should be interested in this. But all of this is none of your business as an intraday trader. Okay, and this is not an opinion. What I'm telling you is something that the market has proven to be true. As an intraday trader, you are planning on getting into the market and you are planning on getting out of the market within the week. Within the week. Personally, I don't like staying in the market over a week. Okay, over a week. On very serious rare occasions, I could stay in the market through the weekend and then I'm out by the next week. Okay, so I frame my trades to hit me out within the week. Personally, I frame my trades. I'm an intraday trader, so I want to get in and get out of the market within the week. Okay, why did I have to do all of that background briefing? I had to do all of that so that you know how to use your time frame, how to do multi time frame analysis. From what time frame you get to the next time frame, you get to the next time frame, and all of that. So this is what I think you should do, and this is what has been working. It has proven itself in the market. This has been tested. This has been proven, and I'm going to show you how. So you need uh, three time frames as a trader. The first time frame will be your higher time frame. Is a time frame for your bias. Your bias. This is your higher time frame. After the bias, we have the analysis. The analysis is the intermediate time frame. The intermediate time frame is for the analysis. Intermediate time frame. This is where you mark. This analysis includes where you mark your structure and where you mark your valid POIs. Let me just say valid zone. Valid zones in the market. Higher time frame, you can use it for bias and also use it to mark zones. All right. Now after this, we now have the lower time frame. This lower time frame is for what? Entry. Entry confirmation. For confirmation entries. Confirmation entries. So these are basically the three time frames you need. So as an intraday trader, for you, these three time frames. First one should be D1, the daily. The second one for your analysis where you mark your structure and your value zone should be H4. And H4 also, this intermediate time frame can also be used for entries if you want your entries to hold strong. And then the lower time frame confirmation entries is M15. So this is basically the three time frames you need as an intraday trader. You need the daily time frame, the H4 time frame, and the M15 time frame. Outside of this, you don't really need much. Okay, you don't really need much outside of this. And I'm going to prove it to you. So in this analysis we're going to do now, we're going to focus more on the daily for the bias and the H4 for structure. And I'm also going to use H4 for limit order entries. Remember, I told you that going low to M15 is for confirmation entries. So the H4 You can set limit order entries in H4. So let's quickly get started. This is Euro USD. We're using Euro USD as a case study. You could see that nothing is here. This market is empty, it's plain. I've not marked anything. Let's get right into it. So we're on the monthly time frame. Like I said, we don't need all of this. Although you have it there so that you can as well, it gives you the eye view. You're not a position trader. You don't need to know what happened in 2022. You don't need to know this. You just need, as an intraday trader, the data you need, the immediate data you need to execute a trade for the day is a data of the past quarter. I think if you can go back 3 months backwards, 6 months backwards, you should be good to frame your trade for the day. Remember, you're not a position trader, so you are not planning to hold this trade. Okay, you are planning to just get in and get out. The data you need should not be more than a course of 3 months, or at most 6 months. But I even prefer 3 months. So we cannot see it on the monthly time frame. Let's quickly just get into the daily time frame. Like I said, our daily time frame will be our bias, our time frame for bias. It will be our time frame for bias. And we are focusing on what has been happening within the last 3 months. What has been happening in the market within the last 3 months. I don't know what is happening. Why is this like this? Okay. So you could see that on the third eye view, we have a high that put in a low, and we have a new high. We could practically say that this is bullish. But then if you look at where we started to mark from, it was 2022. We don't need those kind of data. All right. So we just need to mark from on the daily. What do we need to see? We need to just get our bias. The bias is very obvious here. The bias is bullish. But if you want to know how we got the bullish bias, you could clearly see that we are from this February of 2025, we've been bullish till here, came back, took liquidity, and we are still bullish. Okay, came down here to take liquidity, and we are still bullish. So we've been bullish since then, getting this drawn liquidity, this high here. All right, that happened in January of 2026. So in January of 2026, Euro USD did a retracement. Okay, this is not a reversal, this was a retracement. So this was a retracement. It did a retracement to peak order, and of course continued with its bullish structure. So we can clearly see that the immediate structure, the immediate bias of this market is what? Bullish. How do you see that? You put a trend line to this, is obvious. All right. You put a trend line to this, is quite obvious. So we are very much bullish on this pair. Right. So your daily gives you what? Your bias. So we've gotten our bias. Our bias is what? Bullish. In this bullish bias, we're going to be having bearish retracement, bullish expansion, bearish retracement, bullish expansion, bearish retracement, bullish expansion. That is how this will continue until we have a structure shift or whatever happens. But until then, this is our bias. So we've gotten our bias on the daily. What do we now do? What do we now do? Okay, let me leave that. Might come in handy. We'll go to 4 hours. We'll go to 4 hours. So before this bias became bullish, the previous bearish retracement, where was the what they call it, inception, and where did it end? It originated from here, ended here, right? I'm not marking this trend line to connect the highs or to connect the lows. I'm just marking this trend line to connect inception point to termination point. Inception point to what? Termination point. This was where it began this bearish move began here and it got terminated here. So we can clearly see that, okay? From the inception point to the termination point, we can clearly see that. So when you mark it like this, you are not marking the high or the low of it, you are just marking the inception to the termination. If you mark it, you could clearly see your lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So let's mark the closest structure to that. We have this, we have this, we have this. When price putting this new lower low here, when price putting this new lower low here, what did price do? Price put in a lower high, actually. Put in a lower high, but that lower high failed to create a new lower low. It failed to create a new lower low. It was this lower high was supposed to create a new lower low to continue on this bearish trend. So what did he do? He created what we call a failure swing, failure to swing. That means this structure here failed to swing below this, failed to break this. Okay, this is one of the early indicators that price is preparing to shift structure. How was the next thing price did? Price rallied up and closed here. So let me leave it there for now. Let me leave it there for now. So when price closed here, what did it confirm? It confirmed something. It confirmed something. What did it confirm? It confirmed that price wants to change structure. There will be a shift in market structure because that zone is actually a valid demand zone. I'm scrolling all the way back so that you can see that yes, there's a demand zone there. You can see this demand here. This demand zone here was the zone that price came from, that price is reacting from rather. So you're going to, whenever you see price reacting like that, you're going to ask yourself, is it a valid demand zone or is it a valid supply zone? Price can only react from valid demand and valid supply. All right, valid demand zones and valid supply zones, where you're going to have your other blocks and all of that. So let me just mark this to the point where it reacted. You could see, you could see that the reaction is coming from a valid demand zone. I mean, it's coming from a valid point of interest. Now, when it got here, when market got here and this zone, when market reacted this way inside of this zone, it goes to show that yes, there's a likelihood that there's a high probability that market wants to shift structure in this zone here. All right, market wants to do what? Market wants to shift structure in this zone. So market actually shifted structure, and I'll show you how market did that. I'll show you how market did that. Let me take off this. So let's mark at our last. Okay, we've already done that. So the last low, market putting this high, putting this low, and putting this high. So we could mark here as our market structure shift. All right, we could mark there as our market structure shift. We could mark there, but if we want to mark internally, we could as well mark here. Both of them are correct, but you have to be very very careful and sensitive to these things so that you don't mark liquidity zones. Okay, market put in this last high and failed to break structure here. It now broke above here. This is market structure shift, which is very valid, of course. There was no pullback here after market broke this structure shift. For the first time market did a pullback here and then closed above. So this becomes your inducement. Then your entry, of course, came here, which was this. Closest round liquidity is this. So you're out. We are going to frame all these trades using the 4-hour time frame. This one I just explained. Let me frame it. So when market was selling, market created this internal structure. Immediately market dug into your POI, into that POI, and you discover that that POI is a valid zone, is a valid demand zone. This top that I marked was the last pullback, then did a failure to swing, and then it broke it. This was a valid, what they call it, structure shift or change the state of delivery, as the case may be. So here was our inducement. Here was our inducement. Here was our inducement. And then after this inducement, where is our trade? Where is our trade? Our trade came from here. So we're going to mark this trade right here, the OB, the main order block. That was how we got this buy that tapped in here and rallied up. All right. That was how we got this buy that tapped in here and rallied up, because your closest drawn liquidity would have been this high, and you're out 1:2, 1:3, blah blah blah, whatever. You're out. So you dug into this zone and you're out on this high. Whenever you are doing your targeting, whenever you're doing your targeting, you should always target closest draw on liquidity. Your objective target is the closest draw on liquidity. Of course, the closest draw on liquidity is not the only liquidity. It's not the only target zone. It's just that it helps you to get in, get out. Like this trade now. This trade now got a put order on Thursday by 6 a.m. By 6 p.m. you're out, even though the 1:3 trade. That is the issue with the 4 hour time frame. The 4 hour time frame is an intermediate time frame. It's not so high, but it's not so little, because your trade will take time. Your trade will take time to play out. So this took 12 hours. It took 12 hours to the target, and it's just 1:3, right? Just a 1:3 trade. So you can see that. So immediately after we did that, immediately after we got that, what was the next thing market did? What was the next thing market did? This high now the market created, this high, this was the market structure shift, this was your inducement, and this was when price picked order and delivered to this high. But then this high right here did something, because now we want to continue this trade. When price hits your valid zone in the market, pay attention carefully. These things I'm explaining are very sensitive, because this has the capacity to transform your trading. When price hits your valid zones in the market that you've mapped and gives you a valid change, market structure shift, and all of that, and does all of this thing, you don't look for it in random places. You don't trade it as a pattern. There's a logic behind it. It must be reacting off a valid zone that you have pre-mapped. Okay, you can even set price alert waiting for those zones to trigger. So immediately price came into this zone and did this, you know that yes, we are looking towards getting a good trade from this. This happened on 16th, Monday 16th March, and the trade was on Thursday 19th. You see, from Monday you were waiting, you saw this setup till Thursday before you could take it. All right, immediately that happened. The next trade that we could find here, I'm trading all this, I'm doing all this on the 4 hour time frame. Okay, because you could set limit order on 4 hour time frame. Coming down to anything here is you want to do refinement entries, confirmation entries, refine it to get a higher risk to reward. So for the first time, you need the market structure shift. This is the concept of reversal. To reverse the market, you need market structure shift to reverse the market. So market has reversed here. But after that, the concept you need to continue taking trades in that direction is called the concept of continuation, double break of structure. when market breaks structure beyond one structural zone, you could see that when this candle took out, when market was heading to create this high, it took out this high, which was a valid high when market was selling, and then it took out this high also, which was our previous target, right? So how many zones did it break? Two, and that makes it a what? A double break of structure, DBOS or DBS, double break of structure. This was an IDM. This was an inducement. Okay, this one here was the market structure shift that created this inducement. Inducement is the first valid pullback after a structural shift or a break of structure. So when market broke this high with this candle body, this candle did not create any pullback. It just kept buying. This was the first time this market was having a pullback after this break of structure. After this market structure shift, this was the first time it was having a pullback and then got into this zone and then still rallied up. Okay, so this became our inducement. The closest point of interest to this inducement is this OB. So you get the OB, market into the OB and delivered price to target. Immediately price delivered to targets, broke beyond the targets, cleared this other high here. We have our double break of structure. After our double break of structure, we expect a pullback. Now, what did price do? Pullback that will serve as the what? As the inducement. What did price do? Price started selling. You could see this low until it sold to this point and rallied up to take off this candle that broke structure. Okay, rallied all the way to this high. All right. So after this, where's the valid inducement? Is it here? 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 It is this last, the depth of that pullback. If you mark it, after market from here went to this high, the next low it created was here. So this was the pullback. Then put in this high before it started putting in this low and all of that. You put in this low, put in this high, and then put in this low. So we are not looking into all of that. We just want to validate our inducement. So this was our inducement. You mark it. I just want to show you how you would have caught these trades on Euro USD starting from what? The month of March. Because I'm suspecting that price action is beginning to, get back to its senses. So we have our inducement here. This was our double break of structure. It took out this structure high and this structure high. Double break of structure. We have our inducement. And after marking our inducement, the last sell candle here, of course, is the POI. So the last sell candle is the closest to the inducement. How do we do it now? We mark it out. That is it right here. So we'll mark this out. And that was why you could see market reacting from. Let me take away this trend line. That was why you could see market reacting from here. Of course, your SL is going to be after the sweep, slightly below. And in this whole thing, where's our closest run liquidity? This high. Of course, it's this one. We're going to use this high for it. Okay. This one is the closest run liquidity because this was the inception of this trend and this was the termination of it. A trend line has an inception point and a termination point. Inception point and a termination point. That is what a trend has. So you always ask yourself, where is the inception of the trend? Where did the trend get terminated? So this is the inception and it terminated down here. This whole thing started from here up to this zone. All right. So that becomes our target. We use it as draw on liquidity. That becomes our target. Or we can also use this high here. This was the actual high that was inception. This was it. Just this one, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high before we did all of this. So, all right, let's start our long two. We'll get in on the trade here. Our SL is just slightly under here. Our target is this draw on liquidity here. So gives you a very solid 1:5. You could as well take it to this other drawn liquidity. It becomes a 1:6 trade. All right. So the only issue with this trade is that it took some time. If you get in on this trade on 30th of March, you have to come out on 7th of April. Why? Because there was a deep pullback. So people that know how to do targeting a lot, they will just come out somewhere here, which is still a very solid trade. It's still a very solid trade. 1:5 for this trade is still very solid. You come out here, and when you come out there, you have what? You come out on the 1st of April. You come out on the 1st of April. You understand? 1:5.5. You enter on the 30th, you come out the next day. This one you enter, you come out the next day. Okay, this one you came out the same day. This one you come out the next day. Be marking how many trades I've spotted now. We're just going to be trading continuations until this whole sell liquidity is taken. This whole sell that came down like this, until it is taken, we are buying. We are buying. We are going to buy until this high. So we've gotten our first trade 1:3. Now second trade 1:5. Let's continue. I just want to frame what has been happening in Euro USD for you. Another thing about trading on the 4 hours is that you have to be extremely patient. There's a lot of waiting. You wait for the formation of the setup. You get into the trade. You wait for the trade to play out. Okay? But you need to know what you're waiting for. You need to do what? Know what you're waiting for. Now, after this, after price delivered this price, what delivered targets? What did it do again? How did I get this 1:5 target? I came out the body close of this high, the body close of this high, because sometimes price does not take away the wick, it just takes away the body close, the body enclosure, the open, the market close of this high and the market open of this high. Okay, candle close of this high, candle open of this high. Was why I put it there. You could see exactly at that zone you are out. It's also a way to target so that you're not stranded in the market. If not, this market retraced before it finally give TP. It's plus 1 week. It's after a week. You pay commissions, you pay spread and all of that. There's so much spread and there's so much commissions for that. So you don't want to find yourself in that. Immediately price started buying delivered price. The next thing that happened was we got another structural break. This candle, this single candle, is something wonderful. It broke multiple levels, multiple zones, multiple highs in the market. All right, it took away this high, it broke this high. When I say break a high, it means closed above the candle wick with a body. How many highs did it actually break? If you calculate it, you see that it's almost up to like 5 highs. That is one. We're going to mark everything because we want to see the effect of this in the market. It broke this high. That is two. It broke this high. That's three. It broke this high. Stay with me. I'm marking everything. It broke this high. And I'll tell you the importance of all of these things we are doing. It broke this high and then it broke it broke this last high here. It broke this last high here. So you can see one, two, three, four, five levels that this candle actually took out. All right. So what do we call this? This one took out two levels. We called it a double breakup structure. At the highest level, the last zone it took out, you just title it multiple breakup structure, MBOS. This is the valid zone we are looking at. So market took out how many zones? One, two, three, four, five zones. This single candle broke above five previous highs in the market. It's a very strong. This shows bullish momentum that the bulls are still in charge of the market. There's still so much pressure to buy, right? So multiple breakup structures, five structural highs that was taken by this single candle. All right, five structural highs that was taken by this single candle. And remember, we said that our inducement is the first valid pullback the market makes after the multiple break of structure or after the double break of structure, or as the case may be, after the market structure shift. After this candle that broke all these structures closed here, was there a pullback? Of course, there was a pullback. Where was the pullback? There was a single candle pullback. This candle opened and did retracement first. The first thing it did was to do a little retracement before going to the upside. All right. So that zone, that small place you see, can serve as our inducement because there's already so much bullish momentum. You don't need structural liquidity, you just need inducement liquidity. So this place that I just marked is our liquidity. All right. And trading a pair like trading in a market like this, when you see this kind of a candle, there's so much volume for the bulls. You mark out your breaker block, which is the body high, the body of the highs that was broken. So this was the last high that was broken. This is the body of that high. We'll mark it out. Mark out the body here. The body of that high, this is it. And if you observe what did market do, market tapped into that high and rallied up. Okay? Tapped into that high and rallied up. Your first point to come out will be to come out here, which is the closest drawn liquidity to come out here. Of course, that is not the only drawn liquidity. That is just the closest draw on liquidity. It's not the only drawn liquidity. So we want to come out here. We don't want to hold this trade unnecessarily long. You catch another one is to, a very healthy one is to 3, almost one is to 4. So you want to come out at that high. If price was stalling in that high, you could come out at the body close, the body enclosure. Let me see the body enclosure. It gives you 1 is to 3, come out at the body instead of waiting to clear the liquidity at the wick. That way, you have a 1 is to 3 point something trade. All right. That is not the only liquidity in the market. That's just the closest liquidity in the market. This one, you get in, get out. Let me see. You get in on Wednesday, 6 p.m. You come out on Thursday, 6 p.m. So it actually took a full day for this one is to 3. That is what I've been trying to say about the 4-hour time frame. It is so heavy. It, it is best used for limit order entries. You set your limit order. Nothing the market is doing is part of your problem again, you can just ignore it and allow it play out. All right, you ignore it and allow it play out. Of course, all these trades you could as well, if you have the capacity to hold, if you don't mind the spread, the commissions, the main drawn liquidity that we are targeting apart from this internal liquidity is this one, equal high. This equal high liquidity here would have been our main target if we wanted to hold for long. This equal high liquidity here, this equal high double top. So if you're targeting that zone, if you're targeting that zone, you could imagine what market would have done for you, the crazy numbers you would have done. Just that you will hold the trade. You will hold this trade until you're almost crying. But it's not so far off. So you can have two entries. One, you are holding it. The second one, you are getting in and getting out. Okay, as an intraday trader. So this trade becomes 1:10. This one is 1:12. This one is 1:9. Getting same liquidity levels, right? This liquidity level is your target. So your TP, you are coming out at once from everything. But is that the end? No. The final trade, the fourth trade that took us to this level before we did this retracement. Look carefully and tell me if you can see it. There's one last trade before price delivered. Remember, the concept for continuation is double break of structure, right? So for the double break of structure, where else did price break double structure? If you look carefully, you'll see that around here there was a structure high, another structure high, and price broke it with this small body. You could see this small body here. Let's mark this. This was a structure high. This was a structure high. Price broke it with this body here. Broke this high and this high with that body. All right. That was what price did. This high was broken by this candle body. It must break it with a body. So when it took that high, I knew that, yeah, because the next day market opened, that was on a Friday, the market opened and market dumped down, started buying back up. Dumped down and started buying back up. So when it took that high, it was a valid double break of structure. All right. It was a valid what? Double break of structure. Immediately it did that. Next low that market created was this low here. So this low here is going to be our what? Our liquidity. This low here is going to be what? Our liquidity. Can you see that? So this low right here acts as our liquidity. We are going to mark it. Let me mark it here. This is our liquidity low. So we can see all of this. So what is our risk to reward ratio? What risk to reward ratio do we have right now? When price did this became our inducement idea. This was our DBOS, double break of structure, took out these two highs and created this inducement here. What is the closest POI? This other block right here. This other block right here is our closest POI. So we'll mark as our other block to this low. If you pay attention to what I'm saying, you will understand that technical analysis at this level is basically you just playing around because there's no reason why you shouldn't be profitable in the market with this knowledge. Sometimes price action can be messy, but sometimes price action is so clear, so obvious that if you know what you're doing. For a lot of people, for example, for my very self, my primary problem that I've always had is I love trading on the lower time frame. I enjoy trading on the lower time frame because I want to get in a trade and get out of a trade within the day. So I actually enjoy trading on the lower time frame. The issue with trading on the lower time frame is that you get stopped out because the structure is not clear. Where price is coming from and where price is heading to. Price could be in a retracement and you're trading inside of a liquidity pool. Okay, you are most likely to be trapped in a liquidity pool when you trade very low time frames. Okay, very low time frames. You use low time frames to do confirmation entries in your valid zones, confirmation entries. But if you actually want to trade limit orders, it's 4 hours. It took me time to figure this out, but I have figured it out, and this is what I'm doing right now. And this is why I am explaining all of these things. You could see this is 1 is to 10, 1 is to 12, 1 is to 9. How many risks to reward are we seeing now on the 4 hours time frame? And when price did this, price picked order around here. This is of course the closest drawn liquidity, which you would have been at by now. But then your second position should be open till this high, till this high. Okay, till this high. So all these ones has hit TP. They hit TP around here. All of them hit TP. This position you are holding should hit TP around here. All right. And you can still as well hold till this high, but that will be very, very long term. That will be very, very long term. You wouldn't want to do that. This boot up is okay. You're out. So this one, let's add it. Put in something like this. Your target is here. TP1 is there because this is actually your setup. So even on this one, let me see. You entered on Friday. Okay, entered on Thursday. Thursday what time? Thursday 2 a.m. That is why you set limit orders for this thing because you might be sleeping by 2 a.m. You came out by Friday 10 a.m. That means you actually came out over 24 hours. But it's good. This is one is to 1:7. Okay, 1:7, and that 1:7 is not all there is to it. Oh, it's not all there is to it. It's advisable you come out here, especially if you are still building your account, because all these retracements you might not have the capacity to hold it, the psychological capacity to hold this retracement almost back to the entry before it finally went back up. That was on 6th May. Meanwhile, this trade played out, gave you TP on 1st May. So it will cost you more 1 week of torture, psychological torture, just to break above this TP that you did not take. So drawn liquidity, the closest drawn liquidity, the closest high or the closest low, the immediate pass low or the immediate pass high is your closest drawn liquidity. You always take profit on those levels. Then let's say you take profit there and you have one running trade, getting this candle open and candle close. Okay, candle close and candle open here. So you have a 1 is to 14. You've doubled it. 1 is to 14 trade, which is running, right? Which is still running. Now, the trader I said want to join is you look for multiple break of structure. For now, for some time, we've not had it in such a way that we can join the market. Because if you observe what market has been doing, it has been creating has been creating highs and highs and highs and highs and highs and highs. Though around here, I can see something like it didn't do that. Did he do that? What did he do? It swept this high. This high was broken by this high, but it was a single break, not multiple break. It broke this high. This one was broken here. This one was broken here. And then all this as liquidity. So all of this, why I can't really see anything right now is market is heading somewhere and it's just taking its time. What I want to see right now, what I want to see right now that will help me make it an entry decision is I want to see price take out this high here, close above this high with a body, break this high with a body, close above it with a body. You understand? When price breaks above this with a body, I will be able to see how I will now join this trade because when price breaks above this with a body, of course, it's going to break through this one also. You could see it has been struggling to break it, and this is the weekend already. This is Saturday. I'm doing this analysis on a Saturday. You could see that price did not break it. It swept. It's almost like sweeping liquidity, but it did not break it, which is the issue we are having. It swept this high, and of course, we still have this high. So all these highs now, I want to see an impulse candle that will blast through it. It gives me a stronger confirmation of what I'm looking for, just like what happened here. Right, this was one, two, three, four, five zones that the market blasted through. All right, market blasted through it. So here I'm expecting at least a candle that will blast through these three zones. Once it does that, once I see a candle that blasts through these three zones and closes with a body, I have my trade. That's when I can now say, okay, this is what I want to do with this trade. So I want a candle that will blast through these highs. So I'm going to set a price alert for this second high. It becomes valid, the trade becomes valid when it breaks through the second high. Even if it doesn't break through the third high, it's okay. So I'm adding an alert. An alert is there now. So immediately price gets that high and gets this high and closes with a body. I have my first criteria for an entry. So I have my double break structure. It could be multiple breaks, but double breaks also serve. All right. So once I have my double break of structure, I'll watch out for whatever price does to give me inducement. Then I'll watch out for whatever it will do to give me an entry. The closest POI I'm going to use to get the entry. So guys, this is this is phenomenal. This is not um so difficult as people make it seem. The thing with trading is that you can either be knowledgeable or you can be profitable. So you have to start with the knowledge, of course. The more you learn, the deeper you understand the market, the more you participate in the market, the deeper you understand the market, the more you can interpret the market. And ultimately, with time, you can then start getting profit from the market. So this trade is giving us 1 is to 10.67. This one gave us 1 is to 12.78. This one gave us what? 1 is to 9 point what? 9.89. So place, from this place only, from this place, which was 19th March to 9th April, within a month, you've done 33.29 risk to reward ratio. So if you are risking $1,000 per trade, you are up to 3K. So no matter the spread, no matter the commission, you are still up on some very, very good, healthy profit within a month. Within a month, how many people do such numbers in a month? Very few. So you need to really understand what is happening. Okay, let's now add this one. Though this one is still a running trade, let's assume it as ATP 14.18. So if you add everything, it gives you 47.47. 47.47. Let's assume you are risking $20 on each trade. $20. You are getting close to $1,000. Just risking $20 on each trade. Just 4 trades you've been able to take. Okay, so this strategy has an insane level of win rate, but you need to understand the time frame it works on and how to frame it. It has an insane level of win rate. You could see the insane level of, and it has an insane risk to reward ratio. Okay, so this is what Euro USD. You can practically frame this in any pair, on any pair. I'm using Euro USD. You could see how I'm framing it, how I'm flowing it, how I'm framing it, how I'm flowing it. And this is how it will go till this liquidity is taken, at least. We still have this liquidity resting here. All right. So if this makes sense to you, if this is the first time you're coming across my content, if you want to learn more how this works, if you want to contact me for anything, this is basically how the market moves. This is basically how the market moves. I can do it on different pairs. You don't need so much pairs. Even if it works fine, there are some pairs price action works better. Okay, trade major pairs. Trade pairs that has volatility, pairs that actually move. Okay, sometimes you struggle with your trading, you struggle with your strategy because you are trading a pair that has very low volatility, a pair that struggles to move, a pair that doesn't breathe well. You trade major pairs and you will see that once there's volatility in the market and price is moving, you are covered. Whatever it's doing after you've entered is no longer your business until it hits you out. This is the kind of trade you take, and you can hold a trade to take profit, or you hold a trade to SL, stop loss. Whatever happens, you're fine. Okay, whatever happens, you're fine. So taking your trade on the 4-hour time frame, you've seen how we took one trade, two trade, three trades, four trades. This is exactly how you should be trading. You should not be in and out of the market, in and out. You should not always be on your screen. The only time you come to your screen is your alert has gone off. I've set price alert. If this alert goes off, I will look as the candle close above. Yes, candle has closed above. I will mark it. I will wait for the next candle to close, and I will see how it closed. Price alert and alarm. You can set your alarm on your phone to notify you to go off at every 4-hour candle close. So at any time a 4-hour candle closes, we have 6 4-hour candle closes in a day. So anytime it closes, you can take a look at the market and see what the market is doing at that current time. Okay, the next thing that should bring your attention to the market should be your price alert. Outside of that, by weekend you do your analysis, you know what you are waiting for. You should know what you are waiting for. If price action is not clear, you are not participating in the market. It is fine not to participate in the market. Preserve capital and wait for price action to be clear. If all these things are marked now, you can spot market is not in a zone where you can trade it. Because sometimes the market will just be doing what it's doing, but it's not in a zone where you can trade it. Because it is not in a zone where you can trade it, you are forcing trades. You want to force trades, and if you force trade, it will burn you. Do you get? If you force it, it will burn you. All these things happen at critical zone. Any place you see market reacting from, market is reacting from a critical zone. When market did this pullback and reacted from here to continue the buy, this became our drawn liquidity. Market was doing all of that. You could see what market was doing. All right, you could see what it was doing until market created this high and started bearish move just to come and pick order using clearing all these things as liquidity. All these things, he cleared it as liquidity. Cleared all these things as liquidity. So I hope this makes sense to you. I really hope this makes sense to you. If it does, that is good. If it doesn't, and you really want to learn it, you can reach out to me. We can talk about that. I can put it through. Okay, I have my paid mentorship. I can put it through, and you can start trading for yourself. Of course, you don't have. You must not be a beginner. You shouldn't be a beginner. Rather, you should not be a beginner. It is an added advantage if you're not a beginner. But if you're a beginner, still no problem. We can still work something out. So thank you guys for your time. Thank you for listening. Thank you for being here. Thank you for engaging. Until we meet again next week, I'm going to do another breakdown like this, the setups that played out, and we are going to look at it together. All right. So you must not trade every day. You don't even need to trade every day. In a week, you should be looking for your highest probable setup. There's something that Mark Douglas called it. Let me look for it. There was something that he called it. He said, wait for the trades. Wait for the trades that feel obvious, where you see your setup in its purest, highest probability form. You see your setup in its purest, highest probability form. You see your setup what? In its purest, highest probability form. Until you see that setup at that level, you don't have a trade. So sometimes you might even just get a trade in 2 weeks, or you get a trade in 1 week. You don't necessarily need to get trades every day. That is where the noise happens, and that is where distraction lives. So with this framework, I wish you the very best. Do stay true to yourself. Bye bye for now, and have a blast. I remain yours truly, Big Glue. Thank you for engaging. Bye bye.